Good afternoon, everyone, and thank you for joining us today on this webinar on NCUA's revised capital adequacy standards. This is Tom Fay. I'm the Director of the Division of Capital Markets from the Office of Examination and Insurance. You may have also noticed that we have provided you with some additional resources today for you to have, including a chart on risk weights at a glance. This is an updated chart for you to have in terms of just viewing the risk weight measures for the RBC denominator. Two, we provided you with an Excel template, which would be a very user-friendly calculator for both the CULR and the risk-based capital form. Thirdly, and you certainly can access Part 702 on the Federal Register, but we've also provided it here in PDF format. So as you know, Part 702 capital adequacy went under some significant revisions as of January 1st, not only for these capital adequacy standards, but also for subordinated debt and other parts of 702. So I would strongly recommend that you give Part 702 a read through with all those changes it's gone through. And lastly, we are providing a copy of the slides that we're going to use today as part of this webinar. You can submit questions, by the way, during this webinar, and we will respond to as many as possible after our presentation, of which Susan Brown, colleague of ours in E&I, will coordinate the Q&A session. To submit a question, as you may already can see, please use the submit question box in your webinar console. There are a few technical tips before we get started, in case you're experiencing some difficulty with video or audio. First, make sure that you allow pop-ups from this website. Second, if your display is not clear, get your screen resolution to at least 1024 by 768 to see the presentation. And lastly, if your volume sounds too low, check to ensure your volume is turned all the way up, both on your computer and inside the webinar console. Okay, so before we start, I would like to introduce NCUA's Chairman of the Board, Honorable Todd Harper, who would like to say a few introductory remarks. Thank you, Chairman.
Thank you, Tom, and good afternoon, everyone. I am pleased to join with all of you and appreciate your interest in today's webinar, which focuses on the NCUA's revised capital adequacy standards that went into effect at the start of the year. As we begin, I want to thank NCUA's Director of the Office of Examination and Insurance, Kelly Lay, and her entire team for planning and coordinating today's webinar, as well as their work in developing the complex credit union leverage ratio, or CULR for short, that was approved by the NCUA board in December. Both the risk-based capital and the CULR rules only apply to complex credit unions, those with more than $500 million in assets. The NCUA understands the implementation of the 2015 risk-based capital and the 2021 CULR rules have generated a lot of questions among credit unions, vendors, and other stakeholders. I want to assure you that today's webinar is designed to answer as many questions as possible and to alleviate any of your concerns. This webinar will also provide valuable information that will help you to better understand the requirements of the two rules and to navigate through the resulting changes to the call report. I have long held that all financial institutions backed by federal deposit or share insurance, including federally insured unions, should hold capital equal to the risk held on their balance sheet. This is an lesson that I have learned after more than 25 years in financial services policy. If a credit union with significant risk on its balance sheet fails, risk-based capital will help to minimize the losses to the National Credit Union Share Insurance Fund. This capital protects credit unions, credit union members, and the American taxpayers who ultimately guarantee their insurance fund. Capital, after all, is the first line of defense against losses. The 2015 Risk-Based Capital Rule and the 2021 Complex Credit Union Leverage Ratio Rule will help ensure the continued stability of the credit union system as it navigates the next phase of the pandemic and in the years ahead. The NCUA recognizes that credit unions and vendors need time to work through the required changes and update their systems to account for these new rules. I want to reassure all of you that the NCUA understands this need, and we are committed to working with you, especially for the first call report cycle when credit unions have to comply with these new rules. Throughout today's webinar, you will learn more about the changes to the call report resulting from the implementation of the risk-based capital and CCULR rules, their related materials, and the resources the NCUA has available to assist you with completing the new sections. As a reminder, since the start of the pandemic, the NCUA has not imposed civil monetary penalties for credit unions that submit their call reports late, and we will continue this practice for the March 2022 reporting cycle. Also, if you cannot meet your submission deadline, our examiners will work with you and your credit union. In closing, I urge all of you to make the most of this webinar by asking any questions you have about the implementation of the rules on risk-based capital and complex credit union leverage ratio. Should you have any additional questions or concerns on the revised capital adequacy standards and the required call report schedules, I encourage you to contact your regional NCUA office, the Office of the National Examinations and Supervision, or our Office of Examination and Insurance. As always, be safe, be well, and be kind. Now back to you. Thanks.
Thank you, Chairman Harper, for your remarks. On a programming note, NCUA will be hosting 2 additional webinars. Both are tentatively scheduled with the dates as you see on the slide, and more information on registration will be forthcoming. The first one, obviously, will be the second webinar on the call report changes that will be effective, as you know, for March 31st reporting cycle. This is a follow-up, by the way, to the February 10th webinar. And given the number of questions and participants that we had on that webinar, we are scheduling a second call report change webinar. So that's tentatively scheduled for March 8th. NCUA will also be hosting a webinar on March 10th, same week, to review the changes for the CAMELS transition. As you know, NCUA is transitioning from CAMEL to CAMELS, adding S for the sensitivity to market risk, and obviously leaving L as a liquidity rating standalone. Next slide, please. Thank you. So joining me, before we get started, joining me today are the presenters. I already mentioned myself, Rick Mayfield, Senior Capital Market Specialist from the Division of Capital Markets. Brian Heitman, also a Senior Capital Market Specialist, Division of Capital Markets. Catherine Officer, Division of Risk Management, and Susan Brown, Systems Officer, Division of Examiner Systems. I'm not calling out everyone that's on the call. I do have other staff members that are with us here today that will help us assist in answering questions when we get to the Q&A session. So thanks to all of them as well. For today, we have produced this material to both guide you through the changes for capital adequacy and to provide you with some reference material in the form of illustrations and instructions that you can refer back to. The board recently finalized the regulatory capital standards that will impact all federally insured credit unions. The agenda for today is to, 1, summarize the changes to those capital adequacy standards effective for 2022. Number 2, review how the updated regulatory capital standards impact each credit union. Number 3, review the risk-based capital standards. Number 4, review the complex credit union leverage ratio. And 5, discuss the other related changes. Before we get into the capital adequacy standards, it is important to understand the history of NCUA's regulatory capital framework. I will not review each milestone in the slide, but have highlighted 3 for the purposes of this webinar. As you know, the current capital framework has evolved since 1998, when Congress enacted the Membership Access Act, which required the NCUA board to adopt by regulation a system of prompt corrective action to resolve the problems of insured credit unions when the net worth of a credit union declines below certain levels. The NCUA board initially implemented this required system of PCA in the year 2000. That is the first highlighted item I have, primarily in Part 702. Specifically, Credit Union Act required the NCUA board to adopt by regulation a system of PCA for credit unions consistent with Section 38 of the Federal Deposit Insurance Act. As previously mentioned, the NCUA board finalized updates to the capital framework regulation with the 2015 final risk-based capital rule, again, the second highlighted item in 2015, and again, just recently in the December of 2021 CULR rule, which is the last highlighted item on the slide. In the following slides, we will discuss the specifics of the RBC and CULR rules, including the goals of each rule, definitions, illustrations, and the call report forms themselves. NCUA's capital adequacy standards have several goals. First, NCUA must be faithful to the Federal Credit Union Act in designing an effective and modern risk-based net worth requirement. Thereby, second, supporting the mission of the agency in protecting credit unions and the Share Insurance Fund. Third, capital standards for credit unions also need to be more risk-related. The scope of the standards are calibrated to address outlier credit unions, those institutions with not enough capital in relation to their asset quality. It is important to note these revised standards are not intended to systematically increase capital levels across the credit union system. Credit unions, by and large, are well capitalized, and the vast majority have more capital than what is required by the updated capital requirements. Lastly, capital standards should be calibrated to ensure credit unions that take above average risk are better able to absorb losses, leading to a safer, more resilient, and more stable credit union system. Improvements will provide more protection to the Share Insurance Fund, which should reduce the cost of future failures. This slide illustrates at a high level how the capital adequacy standards are changing for all credit unions. The top chart illustrates what the capital adequacy standards were up until December 31st, 2021, using the net worth ratio and the RB&W ratio. As you're already familiar, the RB&W requirement was for credit unions with total assets greater than $50 million. The new standards in the bottom chart increase the complex asset threshold to $500 million for an additional risk-based requirement, capturing only institutions that should have the necessary resources and sophistication to evaluate their balance sheet using the more nuanced approach. Additionally, by taking a more cautious approach to rolling out an RBC framework for credit unions, we believe the concurrent rollout of RBC and the CULR will allow credit unions that have already elected to carry a higher level of capital to benefit from a simplified framework. Keep in mind, the net worth ratio requirements haven't changed and will continue to impact the institution's PCA category. The new RBC or CULR approach just adds a second measure to evaluate elements that the net worth ratio doesn't capture. The final PCA category will be the lower of the two measures, whether you're using net worth and RBC or a standalone CULR, which I'll refer to in the next slide. In summary, the capital adequacy standards for federally insured credit unions starting in 2022, with exception to new credit unions, will be as follows. First, credit unions who are not complex, that is, credit unions with total assets less than $500 million, will only be subject to a net worth ratio for PCA purposes. This is a big relief for approximately 4,300 credit unions, or 86% of the industry. Second, for complex credit unions, if not eligible or choose not to opt into the CCULR framework, will be subject to both the net worth ratio and the RBC requirements. With that, a complex credit union would need to have a net worth ratio of 7% or greater and an RBC ratio of 10% or greater to be well capitalized. Third, if a credit union meets the eligibility requirements and opts into the CCULR framework with a net worth ratio of 9% or greater, then they would not need, and I repeat, they would not need to calculate a risk-based capital ratio and would be subject to the CCULR requirements. Complex credit unions' prompt corrective action capital categories will incorporate the results beginning with the March 31, 2022 call report cycle. While the framework for capital classifications have changed to incorporate RBC and CCULR, it is important to note that the mandatory and discretionary actions based on PCA capital classifications remain the same. These actions are detailed in NCUA rules and regulations starting in Part 702, Section 106. The NCUA board has approved just recently an interim rule providing PCA relief due to impacts from the COVID-19 pandemic. Specifically, the interim final rule makes two temporary changes to NCUA's prompt corrective action regulations. The first change temporarily reduces the earnings retention requirement for federally insured credit unions classified as adequately capitalized. Second, the second change temporarily permits an undercapitalized credit union to submit a streamlined net worth restoration plan if it becomes undercapitalized predominantly because of share growth. If a credit union becomes less than adequately capitalized for reasons other than share growth, it must still submit a net worth restoration plan under the requirements in NCUA's regulations. These temporary measures will remain in place until March 31, 2023. Just as a program note, the remainder of this webinar will primarily focus on the complex credit union requirements for risk-based capital and CCULR. Just a couple more points on the definition of complex, since that was a big change for 2022. NCUA established a definition of complex with credit unions having assets of $500 million or greater, or I should say greater than $500 million. The revised definition of complex is based on an analysis of the assets and liabilities of credit unions. NCUA found that credit unions over $500 million in assets were almost always involved in one or more complex activities and at a higher frequency than credit unions with assets under $500 million. Therefore, a dollar threshold of $500 million in assets, a straightforward and easy measurement to administer, will determine if a credit union is complex. I will now turn it over to Rick Mayfield, who will introduce and discuss the risk-based capital standard.
Thank you, Tom. While we discussed the history of our capital standards earlier, we are now going to focus on why we are implementing the risk-based capital rule. Our capital standards have remained generally unchanged since 2002. During this time, the NCUA monitored changes in international and U.S. banking agency capital standards, given the statutory requirement for our PCA requirements to be comparable to those of the other banking agencies, which received a major overhaul in 2013. The new risk-based capital standards will provide a risk-based capital measure that is more consistent with those used by other federally insured financial institutions. The updated risk-based capital standards are more consistent with NCUA's risk-based capital measure for corporate credit unions and, as the law requires, more comparable to the regulatory risk-based capital measures used by other banking agencies. NCUA, in implementing this rule, analyzed the impacts and benefits of various approaches to risk-based capital, issued 2 proposed rules, held listening sessions with the industry on the issue, delayed implementation twice, all in an effort to obtain a reasonable and meaningful regulation on capital adequacy. The evolution of risk-based capital also needed to address recommendations made by the U.S. Government Accountability Office and NCUA's Inspector General. Both suggested more forward-looking measures needed to be incorporated into capital standards to detect problems earlier. Additionally, we needed to address lessons learned from credit union failures during the Great Recession, which provided compelling evidence that the prior risk-based net worth requirement did not sufficiently recognize risks that contributed to failure. The new risk-based capital ratio will also provide a risk-based capital measure that is more consistent with those used by other federally insured financial institutions. A well-designed risk-based capital ratio standards would have been more successful in helping credit unions avoid failure precisely because such standards are targeted at activities that result in elevated risk. With the risk-based capital system, institutions that are holding assets that have historically shown higher levels of risk are generally required to hold more capital against those assets, thus providing an improved capital buffer more appropriate to the level of risk. Further, a risk-based capital measure is more prospective in that, as a credit union makes asset allocation choices, it drives capital requirements before losses occur and capital levels decline. This more prospective approach differs significantly from the leverage ratio, also known as the net worth ratio. A key limitation of the leverage ratio is that it is a lagging indicator because it is based largely on accounting standards. Accounting figures are point-in-time values largely based on historical performance to date. Further, the leverage ratio does not discriminate between low-risk and high-risk assets or changes in the composition of the balance sheet. The leverage ratio does not account for the riskiness of assets, but can provide a baseline level of capital adequacy in the event that the approach to assigning risk weights does not capture all risks. This slide provides a quick introduction to the basics of the risk-based capital ratio. All on-balance sheet assets and off-balance sheet exposures are assigned a risk weight. Greater risk means higher risk weight. As you can see from the formula here, the capital elements make up the numerator. This is similar to net worth, but with a few additions and deductions that we'll go over later in the slides. Risk-weighted assets make up the denominator. More capital in the numerator is good for the RBC ratio. Conversely, greater risk-weighted assets in the denominator will decrease the ratio. Next slide, please. This slide shows the spectrum of risk weights with some examples to show where common assets fall on the spectrum. As you would expect, cash and guarantee deposits have a zero risk weight as they represent essentially zero risk. On the other end of the spectrum, subordinated tranches are much more commensurate with risk at 1,250%. Current first lien residential mortgages that are not overly concentrated are 50%, while junior lien mortgages that are delinquent or overly concentrated are much higher at 150%. Anything that is not explicitly listed in the rules falls in the all other category of 100%. Risk weights can be found in Subpart A in Part 703, or the risk weight tables can be found on the Risk-Based Capital Resources page on ncua.gov. I will turn it over to Brian, who will introduce the call report schedules to be used to calculate the risk-based capital ratio.
Thank you, Rick. Let's begin with an illustration of the RBC numerator calculation. The majority of numerator components are auto-populated from other sections of the call report. As mentioned previously, goodwill from a supervisory merger is set to the total goodwill in account 009D2. This line, shown here, RB0006, must be manually entered by credit unions. Line 16A limits capital from mortgage servicing assets to 25% of the RBC numerator before this adjustment. The preliminary RBC numerator is calculated in account RB0010. The final RBC numerator is calculated in RB0012 after any applicable MSA adjustment. Now, let's look at the RBC denominator. Risk-weighted assets, or the RBC ratio denominator, groups on-balance sheet assets by balance sheet category, cash, investments, securities, loans, other assets, as well as off-balance sheet exposures. Assets are slotted into risk weight categories across the columns of the calculation worksheet. The totals from schedules column is auto-populated from other parts of the call report, such that the total of on-balance sheet assets here will match the total assets on the statement of financial condition. The adjustments to totals column is used to transfer assets from one category to another as prescribed by the RBC rule. For example, loans held for sale must be risk-weighted by loan type. Once all adjustments have been made, the total adjustments must net to zero. Items 32 through 36 will auto-populate from the liquidity schedule of the call report, using mostly new line items added to the modernized version of the call report. Derivatives are calculated and entered manually, following the methodology described in Part 702.105. Unlike the other denominator schedules for RBC, where asset allocations are directly entered, credit unions must multiply the off-balance sheet allocations by the appropriate credit conversion factor prior to entry. For example, conditionally cancelable, unfunded, first lien mortgage amounts must be multiplied by 10% prior to entry in account RB0126. This slide sums up totals and calculates the results. Line 42 calculates total risk-weighted assets, also called the RBC denominator. Line 43 calculates the final RBC ratio. We will be providing a template of this form on the RBC resources page, and it was also included with the resources for this webinar. The next few slides show examples of transfers that must be made for the RBC denominator call schedules. We will cover unrealized gain-loss for available for sale investments, loans held for sale, commercial loans under $50,000, and Paycheck Protection Program loans. This slide illustrates the reporting of unrealized gains and losses on AFS investments for risk weight purposes. In the gain example at the top, there are nearly $27 million and $18 million of amortized costs, respectively, in the 20% and 50% risk weight categories. For purposes of this example, the assets in those categories have an unrealized gain of approximately $5 million, which is slotted into the 0% risk weight category. The intent of this is to risk weight only the amortized cost for RBC purposes. Notice that the totals from schedules, adjustments to totals, and totals for risk weighting columns remain unchanged. The loss example shows a similar scenario, but with a $4 million loss rather than a gain. The treatment here is essentially the same. The amortized cost remains in the 20% and 50% risk categories, while the loss is slotted into the 0% risk category. Again, the totals columns remain unchanged. This slide shows the transfer of loans held for sale that I mentioned previously. As prescribed by the final RBC rule, loans held for sale must be grouped with their respective loan types and risk-weighted accordingly. In this example, the approximately $5.4 million of loans held for sale are transferred to the first lien and junior lien rows for appropriate risk weighting. I'm only using those two loan lines for illustration purposes here. Here they have been added to the 50% risk category for first liens and the 100% risk category for juniors. In this case, the totals for risk weighting column does change to reflect the transfer. However, the sum of the adjustments to totals column must still equal 0. Loan amounts in the totals from schedules column must also remain unchanged. This slide shows the treatment of commercial loans with balances under $50,000. Unlike the loans section of the call report, the RBC schedule requires loans used for commercial purposes to be categorized and risk-weighted with commercial loans regardless of their loan size. In this example, about $37.5 million of consumer loans have been transferred to the commercial loans row via the adjustments to totals column. Those transferred loans must be fully allocated to the appropriate risk categories as shown on the slide. Please note that the sum of the adjustments to totals column once again equals 0. Total loans also remain unchanged. This slide shows the treatment of Paycheck Protection Program, or PPP loans. Similar to the small balance commercial loan example, PPP loans, which are made for commercial purposes in most or all cases, must be categorized and risk-weighted with commercial loans. In this example, $9 million of PPP loans have been transferred from consumer to commercial loans via the adjustments to totals column. Due to their SBA guarantee, PPP loans have a 0% risk weight. Please note again that the sum of the adjustments to totals column equals 0. The total loans also remain unchanged. I will now turn it over to Rob, who will discuss off-balance sheet exposures.
Thanks, Brian. This is Rob Bruno, a Senior Capital Markets Specialist in the Office of Examination and Insurance. Slide 24 intends to serve as a reference for the off-balance sheet exposures that Brian spoke about a few slides earlier. Brian reviewed the RBC off-balance sheet exposure and derivative schedule earlier in the presentation. As he mentioned, the liquidity schedule, Schedule C, populates the RBC off-balance sheet exposure schedule. Section 702.2 provides a list of exposures included in the definition of off-balance sheet exposures and explains that a credit conversion factor apply to determine a credit exposure equivalent amount. Finally, Section 702.1044 assigns the credit conversion factors and risk weights to determine the risk-weighted off-balance sheet exposure amount. Next slide, please. For most credit unions, unfunded commitments represent the most material off-balance sheet exposure, and in many cases, the only off-balance sheet exposure. For RBC purposes, unfunded commitments are considered either unconditionally cancelable or conditionally cancelable. Unconditionally cancelable means that a credit union may, at any time, with or without cause, refuse to extend credit under the commitment. The contractual agreement must explicitly state that the credit union can unconditionally refuse to extend credit under the agreement. Unconditionally cancelable commitments have a 0% credit conversion factor and therefore are not included in the RBC denominator. However, conditionally cancelable unfunded commitments are ones that do not meet the definition of unconditionally cancelable. Conditionally cancelable unfunded commitments have credit conversion factors of either 10 or 50% and risk weights between 50 and 100% and are included in the RBC denominator. I'll now turn it over to Tom, who will discuss the risk weighting of derivatives. Tom?
Thank you, Rob. Essentially, the risk weighting for derivatives essentially uses the concepts of 1, remaining maturity for each of the contracts outstanding at quarter end, 2, the fair value of those contracts, and lastly, how the gain loss on the contracts are collateralized. And so I've listed some of the terminology here on this slide to get you familiar with the concepts that are used to determine a risk weight and the credit equivalent for derivative contracts. Next slide, please. With that, we've illustrated 2 examples of how this might work. In this slide, the first illustration shows 4 derivative contracts with various remaining maturities and the associated fair value, which in this case is a net positive amount. We are assuming that the transactions are subject to a qualifying master netting agreement. The total exposure, which is the column out to the right, the last column, is a sum of what we call the credit equivalent amount and the current credit exposure, and a factor of the PFE, which is the potential future exposure, both using formulas illustrated here, and are also in the Rule 702, Section 105. Next slide, please. Oh, just one note. Sorry, go back to that slide. One more note. Yes, thank you. So the credit, an interesting feature of derivatives risk weighting is the credit risk mitigation of collateral that can be used, subject to requirements, thus netting the exposure. In this case, we're using cash of $500,000 on deposit, which in turn reduces the overall exposure, and it is slotted into the 0 risk weight category. The remaining amount is allocated to 20% in this illustration, a risk weight used for U.S. banks. Thank you. Next slide. Okay, you can flip it. Okay, the second illustration, back one, sorry. The second illustration uses the same portfolio of transactions from the previous slide, but shows a net negative fair value, which essentially reduced the risk weighting given that the CCE, or the current credit equivalent, is floored at 0. The only part left is to risk weight the PFE or the potential future exposure. The concepts for risk-based capital for cleared transactions, by the way, these were 2 bilateral OTC transactions, but the concepts for cleared transactions are similar, but with potential lower risk weighting for the counterparty. That concludes most of our presentation on the risk-based capital, and now I will turn it over to Catherine, who will discuss the complex credit union leverage ratio, or CULR.
Thank you, Tom. This is Catherine. So what is the complex credit union leverage ratio, or CULR? CULR is the credit union version of the community bank leverage ratio, or CBLR. The CULR utilizes the net ratio as its measurement tool, so there is no need to calculate a different ratio. For credit unions meeting the CULR requirements and opting into CULR, this will allow these complex credit unions to not calculate the RBC ratio. Complex credit unions will, on average, be required to hold more capital if they opt into CULR versus calculating RBC. Next slide, please. Complex credit unions that meet the eligibility requirements have the option to opt into the CULR framework. However, they are not required to opt in. I'll expand on this in the upcoming slide. By opting into the CULR framework, complex credit unions will be required to have a net worth ratio of 9% to be considered well capitalized. Opting into the CULR framework is not a lifetime commitment. We will discuss how to opt in and how to opt out of the CULR framework in more detail shortly. Lastly, credit unions who no longer meet the eligibility requirement will have 2-quarter grace period to return to meeting the eligibility requirements. Next slide, please. This chart provides a high-level comparison of the CBLR and the CULR rule. These are very similar. As you can see, the banking industry does have an asset limit restriction. However, do not limit credit unions with assets greater than $10 billion from opting into the CULR framework. The percentage of net worth requirement to be well capitalized is 9% for both banks and credit unions. The qualifying criteria identified here are established to ensure credit unions with an elevated level of risk continue to follow the risk-based capital requirements to help ensure they hold capital commensurate with the level of risk within their portfolios. The 3 qualifying criteria are off-balance sheet exposures, trading assets and liabilities, and goodwill and intangible assets. Those credit unions with balances in excess of the established thresholds identified will not be able to opt into the CULR framework and will be required to calculate their risk-based capital ratio. Next slide. Oh, no, you're there. Sorry. So how do complex credit unions opt in and opt out of CULR? Complex credit unions do have the ability to opt in or opt out of the CULR framework and will do so by completing Schedule H of the call report quarterly. We will show this form in upcoming slides. We don't anticipate many qualifying complex credit unions will opt out of the CULR after opting in because of the simplicity of the approach. Special cases can occur that may cause a credit union to want to opt out of the CULR. For example, if the credit union anticipates an upcoming balance sheet change, merger or acquisition, or has declining asset quality. In those cases, a credit union may choose to run the RBC calculation to see where they may fall post-change. Additionally, in cases where the RBC ratio would be higher PCA category, the institution may change from CULR to avoid a downgrade in their PCA classification. All of these are special cases. If your credit union is making large changes, just remember to include the RBC ratio analysis, or ask to include an analysis of RBC in any proposals you're making for that change. The CULR framework does include a grace period. If in a subsequent quarter after March 31st, 2022, a federally insured credit union falls below 9% net worth or fails one of the other 3 qualifying criteria, there is a 2-calendar quarter grace to meet all qualifications again. During this grace period, the credit union can still opt into the CULR framework and be considered well capitalized. The exception to this is if the net worth falls below 7% net worth. A credit union that becomes less than well capitalized during the 2-quarter grace period would not be required to begin calculating its capital under the final 2015 RBC final rule immediately. Instead, the credit union would still be eligible for the full 2-quarter grace period. However, it would be subject to any applicable PCA requirements for its capital classification. If after 2-quarter grace period, the federally insured credit union still does not meet the qualifications, they will have to complete the risk-based capital schedule. The call report instructions provide detailed information and scenarios regarding the grace period. We will provide and discuss several scenarios in the next few slides to ensure this is clear. I will now turn it over to Rick, who will walk you through a few scenarios on how CULR works.
Thank you, Catherine. Next slide, please. Oh, there we go. Thank you. Sorry. This slide reflects the revised call report Schedule H, where a complex credit union will determine eligibility and opt-in, opt-out of the CULR framework. The credit union will answer questions 1 and 2 if their asset size is $500 million or higher. If a complex credit union does not opt in or does not qualify, they must complete Schedule I for RBC. The CULR form will auto-populate data for lines 3, 4, and 5. Asset size in line 3, net worth ratio in line 4, and the off-balance sheet exposures in line 5. The call report was expanded to provide data for the off-balance sheet exposure. The credit union will need to populate questions 6 and 7, and the call report provides instructions for these fields. Next slide. This slide and the following 3 slides reflect various scenarios to demonstrate how the grace period applies related to CULR. For each of the following scenarios, the credit union starts out as a qualifying credit union. These screens reflect a 4-quarter history for the opt-in to CULR for demonstration purposes only. However, keep in mind that the actual call report only shows the current quarter. The first scenario reflects the credit union meeting all eligibility requirements for CULR at their initial opt-in for March 31st, 2022. In the subsequent 2 quarters, their net worth ratio fell below 9%, but they continued to meet all other eligibility requirements. For June 30th, 2022 and September 30th, 2022, the credit union can continue to opt into the CULR framework, but must also select yes in question 2, indicating they are opting in under the grace period. For December 31st, 2022, the credit union's net worth ratio once again reached 9% or greater, and they continued to meet all other eligibility requirements. As such, the credit union can continue to opt into the CULR framework and is no longer under a grace period. The credit union's capital classification remains well capitalized each quarter during the grace period, and the credit union is not required to calculate risk-based capital. One note, had the credit union's net worth fallen below 7% at any point during the grace period, the credit union would have had a capital classification of less than well capitalized, while under 7% net worth. Also, the credit union would need to have a net worth over 9% at the end of the grace period to continue to use CULR. Scenario 2 reflects the credit union meeting all eligibility requirements for CULR at their initial opt-in for March 31st, 2022. Next slide, please. I think we're on 1. Okay, thanks. So in the subsequent 2 quarters, while their net worth continues to exceed 9%, the credit union fails other qualifying criteria. Again, for June 30th, 2022 and September 30th, 2022, the credit union can continue to opt into the CULR framework, but must also select yes in question 2, indicating they are opting in under the grace period. For December 31st, 2022, the credit union once again meets all qualifying criteria. As such, the credit union can continue into the CULR framework and are no longer under a grace period. The credit union's capital classification remains well capitalized each quarter, and the credit union is not required to calculate risk-based capital. Scenario 3 reflects the credit union meeting all eligibility requirements for CULR at their initial opt-in for March 31st, 2022. In the subsequent 2 quarters, while their net worth ratio continues to exceed 9%, the credit union fails other qualifying criteria. For June 30th, 2022 and September 30th, 2022, the credit union can continue to opt into the CULR framework, but must also select yes in question 2, indicating they are opting in under the grace period. For December 31st, 2022, the credit union still fails one of the qualifying criteria. As such, the grace period has expired, and the credit union is no longer eligible to opt into the CULR framework as shown in question 1. While the credit union's capital classification remains well capitalized and the credit union is not required to recalculate risk-based capital during the grace period, they will be required to calculate RBC for December 31st, 2022, and their capital classification is dependent on both the net worth ratio and the RBC results. Scenario 4 reflects the credit union meeting all eligibility requirements for CULR at their initial opt-in for March 31st, 2022. However, the credit union took on a supervisory merger in the second quarter of 2022. While net worth remained above 9%, the credit union does not meet all criteria due to the resulting goodwill from the merger. For June 30th, 2022 and September 30th, 2022, the credit union can continue to opt into the CULR framework, but must also select yes in question 2, indicating they are opting in under the grace period. For December 31st, 2022, the credit union still fails one of the qualifying criteria. As such, the grace period has expired and the credit union is no longer eligible to opt into the CULR framework as shown in question 1. While the credit union's capital classification remains well capitalized and the credit union is not required to recalculate risk-based capital during the grace period, they will be required to calculate RBC for December 31st, 2022, and their capital classification will be dependent on the RBC results. As noted this example represents a supervisory merger. Per NCUA's rules and regulations in Part 702, a supervisory merger or combination means a transaction that involves the following. Number 1, an assisted merger or purchase and assumption where the funds from the share insurance fund were provided to the continuing credit union. Number 2, a merger or purchase and assumption classified by NCUA as an emergency merger where the acquired credit union is either insolvent or in danger of insolvency as defined under Appendix B to Part 701 of this chapter. Or a merger or purchase and assumption that included NCUA's or the appropriate state officials' identification and selection of the continuing credit union. However, there is an exception to the grace period if the merger or acquisition is not a supervisory merger. This is defined in NCUA rules and regulations in Part 702-104 D7-5. If a qualifying complex credit union ceases to meet the qualifying criteria as a result of a merger or acquisition that is not a supervisory merger, there is no grace period, and the credit union must calculate risk-based capital in the quarter it ceases to be a qualifying complex credit union. As such, if this example had not been a supervisory merger, the credit union would have no grace period, and would have had to calculate risk-based capital for June 30th, 2022. Prior to any merger or acquisition, management should review and understand the impact to net worth, CULR, and risk-based capital. I'll now turn it back over to Catherine, who will review the impact on the MBL limit with the revised capital standards.
Thank you, Rick. While our focus during this presentation is on capital standards, these changes may impact the member business loan limit for some credit unions. Please note the MBL rule has not changed. The MBL rule establishes the MBL limit as the greater of the minimum amount of capital required by the net worth ratio, which is 7% of total assets, and the minimal amount of capital required by the risk-based capital, which is 10% of risk-weighted assets. For complex credit unions, the establishment of the credit union's ability to opt into the CULR capital framework creates an additional option for the credit union and an additional measure in determining the MBL limit. Accordingly, under the final RBC rule, a qualifying complex credit union that opts into the CULR determines its MBL limitation by reference to the amount of net worth required to be well capitalized under CULR, which is 9% of total assets. However, a complex credit union that does not qualify for or does not opt into the CULR framework will determine their MBL limitation by reference to the 10% risk-based capital ratio compared to the net worth ratio requirement as described in the 2016 MBL final rule. In either scenario, if a complex credit union has actual net worth below those measures, its actual net worth would determine the MBL limitation. To summarize, in determining the credit union's MBL limit, you must first determine if the credit union has opted into the CULR framework, or if the RBC ratio remains as their capital standard. Then you can compare the minimum capital level required to be well capitalized in dollars under CULR or RBC, compared to the 7% total assets. The MBL limit will be 1.75% of the greater of the two. Next slide, please. Let's look at the MBL limit this way. First, we need to know which capital framework is governing the credit union. Has the credit union opted into CULR? When we can determine the minimum capital level necessary to be well capitalized under the capital framework, the greater of the two will be multiplied by 1.75 to determine the possible MBL limit. We have an example of a credit union with total assets of $900 million and risk-weighted assets of $750 million. First, we need to determine if the credit union is governed by RBC or opted into the CULR to determine the minimum net worth in dollars to be well capitalized. Second, we look at the minimum net worth to be well capitalized. The greater of the RBC or CULR, whichever they have opted into, or net worth can then be multiplied by 1.75 to determine the MBL limit. We do want to reiterate in either scenario, if a complex credit union has actual net worth below these measures, the credit union's actual net worth will be used to determine the MBL limitation under the current MBL regulations. We also want to reiterate that the MBL rule has not changed, only the capital framework. I'll now turn it back over to Tom, who will discuss how subordinated debt, when approved, can be used for capital adequacy.
Thank you, Catherine, and thank you everyone for your patience today. I know we're trying to get through as many points of interest as possible today during this webinar, and we do want to leave as much time as possible for questions. We are getting quite a few as expected, so just bear with me on a couple of more items that we want to make reference for your benefit. One is subordinated debt. As you know, this is previously secondary capital. The chart here, which we've illustrated, shows how capital can be used in the calculation of the respective ratios. Obviously, you know that like-yous who have a low income designation can use subordinated debt as part of its net worth ratio. That did not change. That already occurred as part of the Federal Credit Union Act. However, if a like-you is also complex, they can also count it for their RBC ratio, subject to the rules, of course, and being an approved secondary or subordinated debt plan. Non-like-yous, which is the next section down in the brown tan section, can only count subordinated debt for their RBC ratio. And Brian, I think, illustrated that as part of the numerator. Obviously, if you choose to use RBC, then yes, you would have that benefit as part of the numerator, subject to the remaining maturity, of course, of that subordinated debt. It should be noted, though, because the CULR rate, which is the threshold, is the same as the net worth ratio, then the calculus that goes into the net worth ratio will be the same for the CULR ratio. Next slide, please. So in summary and in conclusion, during this webinar, we have provided a great deal of information related to the changes to credit union capital standards. What has changed? The changes increased the threshold for credit unions to be considered complex to those with total assets greater than $500 million. Therefore, credit unions with less than $500 million in total assets are only subject to the net worth ratio for determining capital classification under PCA. With the risk-based capital rule going into effect on January 1st, 2022, complex credit unions are required to comply with risk-based capital or may opt into the CULR framework. For credit unions bound by risk-based capital, they will need to have a risk-based capital ratio of 10% or greater to be well capitalized. If the credit union has met the qualifying criteria for CULR and have opted into CULR, then they will need to have a net worth ratio of 9% to be well capitalized. Starting with the March 31, 2022 call report, credit unions will be able to opt into the CULR framework. In addition, with the March call report, new data points have been incorporated in order to calculate the credit union's risk-based capital ratio. In other words, we've made the form in terms of the data feeding from other schedules as user-friendly as possible. So what has not changed with the new capital adequacy standards? Prompt corrective action as outlined in Part 702. The requirements of PCA remain unchanged. It is just the means of determining the capital classification that may differ for complex credit unions. The need to ensure the accuracy of the call report is also unchanged. As the call report will calculate the risk-based capital ratio, it is imperative to ensure the accuracy of the information entered by the credit union. Due to the number of changes to the call report, we anticipate there will be increased questions regarding call report entries. We will be providing additional resources to assist you in answering these questions in addition to call report specific training. However, we know district examiners are the first in line when it comes to industry questions and want to assure you that they will have a basic understanding of the call report changes and who to contact for assistance. Capital adequacy remains imperative, and it is a supervisory priority for 2022. While the capital framework may have changed, our need to assess capital adequacy and disclose any concerns to a credit union have not changed. We must ensure we address any concerns we may identify during our examinations and supervision as we have in the past. Next slide, please. On behalf of our presentation teams, thank you for your attention and patience today, and I hope you were able to clearly articulate the changes to the capital adequacy standards that are effective this year. I provided two links here that you can take with you in terms of the overall call report changes, which, by the way, are now final, and another link to the RBC resources page, which will be updated shortly. This is still with the old 2015 information. We are in the process of updating this in the next week or so you can see those same resources that you retrieved today. Next slide, please. If you have any questions, please reach out to your district examiner or regional office. The Eastern, Southern, and Western regions, along with the ONES office, will have designated personnel to assist you with call report and any capital adequacy questions. You may also send your call report team questions or questions to CU Online. Alternatively, the Office of Examination may also be contacted at eimail@ncra.gov. I will now turn this over to Susan Brown, who will coordinate the Q&A session.
Thank you, Tom. Good afternoon, everyone. This is Susan Brown, and we now have time to answer some of your questions. As a reminder, we're going to post answers for the questions we do not get to today at a later date, so keep an eye out for that. So let's kick this off with a question for Catherine. Catherine, how does a credit union select the cooler option? And if selected, is there a different or separate call report required that includes a reduced regulatory burden?
Hello, this is Catherine. That's a fantastic question. Credit unions will opt into the COOLR framework via Schedule H on the call report. It does not require any additional call reporting, so there's no additional burden. I hope that answers your question.
All right, thank you. The next question we have is for Brian. Brian, if you adopt RBC, do you then need to do, I'm sorry, let me try that again. If you adopt RBC, you then don't need to do COOLR. Is that correct?
Hi, this is Brian. Yes, that's correct. Complex credit unions must choose either COOLR or RBC. There's no need to do both. If said differently, if a complex credit union completes the RBC schedules, they do not need to do COOLR. Thank you.
All right, thank you. The next question I'm going to do is for Tom. Tom, can you explain the implication of CECL adjustment upon implementation on the COOLR option? Basically, if it makes you fall below 9%, can you still use COOLR?
Thank you, Susan. And good question. Obviously, CECL, if you can early adopt, otherwise you would be required to adopt CECL year-end 2022 going into 2023. And if you do wait that long, you will also be eligible for the phase-in. You also know that the phase-in will impact your retained earnings, thus impacting your net worth ratio, which is also your COOLR ratio. So if you already opted into the COOLR and the day one phase-in pushes you 1%, you do have the 2-quarter grace period to restore your eligibility. Otherwise, you would be subject to risk-based capital. Thank you, Susan.
Okay, thank you, Tom. I'm going to stick with you for the next question. Does the 9% net worth ratio in the COOLR increase 10% in 2024?
Thank you. Good question also. It does not. The final COOLR rule from December 2021 utilizes a single rate, and there's no transition to another rate. So 9% is the only COOLR rate that there is. There's no transition higher or lower. Thank you.
All right, thank you. Catherine, next one for you. Can we opt into COOLR and still complete the RBC portions of the call report?
This is an excellent question as well. Much of the RBC information captured in the call report will actually auto-populate, so you should still be able to see that information even if you opt into COOLR on Schedule 8 of the call report. I hope this answers your question.
All right, thank you. Brian, you're up next. Is cash held at the Fed considered insured at 0% risk weight regardless of amount?
Hi, so the answer to that question is yes. The Part 702 says obligations of the U.S. government or its central bank, so that's what's covered here in 0% risk weight category. Thank you.
All right, thank you. Brian, I'm going to stick with you and ask, where do commercial loans fall on the risk weight spectrum?
Hello, this is Brian again. There are a few different categories that commercial loans could fall into, so I will list each of those. The Paycheck Protection Program loans that I mentioned earlier are 0% risk weight. Commercial loans that are secured by compensating balance are 20% risk weight. And then any current commercial loans that are less than 50% of a credit union's total outstanding or total assets would be risk weighted at 100%. Current commercial loans that are actually have a concentration above 50% of total assets, or the portion of those that are above 50% of total assets, are risk weighted at 150%. And then any non-current, any non-current commercial loans are also risk weighted at 150%. Back to you.
All right. Thank you. The next question is for Rob. Where do we find the qualifying criteria for CCULR off-balance sheet exposures? What counts towards the 25% or less of total assets requirement? If it says see instructions, but I don't see any further detail.
Hi, Susan. This is Rob. You will find the off-balance sheet exposures applicable to CCULR in the definitions of the rule. Part 702.2 is where definitions are located, and off-balance sheet exposures are specifically defined there. There are 8 of them listed, and those are what are included for the off-balance sheet calculation of CCULR. It's those 8 items that are listed where the total of those cannot exceed more than 25% of total assets, so that the credit union is eligible to opt into CCULR. I'll turn it back over to you, Susan.
Okay, thank you. And I'm going to stick with you for just a second because we have somebody who wants to know if they are able to register yet for the CAMELS webinar.
The CAMELS webinar. I think Tom mentioned early in the presentation that that is scheduled for March 10th, specifically at 2 o'clock. I think the public can expect a NCUA Express message sometime this week, and likely it'll be identified as an event on the events calendar on NCUA's website. Back to you, Susan.
Okay, thank you. All right, the next question I have is for Rick, and it's a long one, so here we go. Secondary market SBA and USDA government guaranteed loan participations should carry a 0% risk weighting, as they are a direct, unconditionally guaranteed obligation of the U.S. government. This is different than the conditional guarantee given by the U.S. government to the guaranteed portion of an SBA 7A or USDA loan originated by a credit union. However, the call report does not allow for any distinction and lumps both the unconditional guaranteed loan participations with conditionally guaranteed loans and assigns them all a 20% risk weight. Please let us know how and when this will be corrected.
Thanks, Susan. This is Rick Mayfield. So I think there's a little bit of confusion here. I think the person who wrote this comment was looking at the Schedule B when they saw that they couldn't put it under government obligations. It was under government agencies. That does not affect how they put it in the buckets in the risk weightings on the RBC schedule. So they would put those under 0% in the RBC schedules, but the Schedule B actually has it a little bit differently. So do that, put the 0% in risk weight in the RBC schedule, and that should all work. Now, there are certain things that are unconditionally guaranteed, like an interest-only strict would not be. That would have a separate risk weight. But in general, those should be a 0% risk weight on the RBC schedule. I hope that answered your question.
All right, thank you. The next question is for Catherine. When considering CULR, are we to use GAAP net worth or regulatory net worth? Catherine?
I apologize. Thank you, Susan. Another great question. So the Part 702 defines net worth with respect to any federally insured natural person credit union as the retained earning balance of the credit union at the most recent quarter end as determined in accordance with U.S. GAAP, subject to certain restrictions. But overall, yes, it's GAAP is the defining marker there. I hope that answers your question.
All right, thank you. I'm going to go back to Rick now. Rick, can you please verify whether a CU with less than $500 million in assets needs to complete either CULR or RBNW, or neither of the two?
So once again, Rick Mayfield. So the answer on that is, as of January 1st of this year, they would not have to complete either one of them. Now, because they filled out, credit unions filled out their the year-end call report, they were still subject to risk-based net worth as of year-end. But starting the end of the first quarter, a credit union under $500 million in assets will not be subject to either CULR or the old risk-based net worth. That concludes my answer.
All right, thanks, Rick. Tom, you're next. If we elect to use the CULR ratio, how are we considered well capitalized? Do we use only the CULR ratio or use also the PCA net worth ratio?
Thanks, Susan. Hi, everyone. Tom Fay here. So the CULR ratio is essentially a simplified measure to satisfy your capital adequacy standards. So in other words, if you elect into CULR and you maintain 9% or greater, which is essentially the net worth ratio, then you are considered well capitalized. However, if you do fall below 9 after you're opted in, you do have the 2-quarter grace period to restore those eligibility criteria back to where they should be. Thank you, Susan.
Thank you, Tom. Okay, the next question is for Vicki. Do pages 23 through 28 of the new call report only apply to complex credit unions over $500 million in assets?
Thank you, Susan. Great question. Yes, Schedules H and I, which is pages 23 through 28 of the call report, only apply to complex credit unions, which is those credit unions with quarter-end total assets of more than $500 million. That concludes my answer.
All right, thank you. I'm going to go back to Rick. Rick, is the CULR ratio calculated? And if yes, can we calculate it in Excel? Or is it only a yes or no response?
So the CULR ratio is the same thing as your net worth ratio. So you've been calculating that the last X amount of years, however long your credit union has been in existence. So you won't have to calculate your net worth ratio again. That number should go into the CULR schedule. That concludes my answer.
Okay, thank you. Next, I'm going to Brian. Brian, what is the RBC hit for auto? I thought I saw 75% secured consumer. Is that correct?
Hello, this is Brian. Yes, that is correct. The risk weight for a current, I should specify that it must be a current secured non-guaranteed consumer loan, which sounds like an auto loan, is 75% risk weight. That concludes my response.
All right, thank you. I'm going to go back to Rick now. Rick, where do government guaranteed loans fall in the risk-based capital calculation?
So government guaranteed loans would be on the asset side, and if they're unconditionally guaranteed, they would be a 0% risk weight, and if they're conditionally guaranteed, they'd have a 20% risk weight. And that concludes my answer.
All right, great, thanks. Let's go back to Tom now. Tom, is ALLL added back to the capital for risk-weighted capital purposes?
Thanks, Susan. Hi, everyone. Tom Fay here. Yes, for the risk-based capital numerator, which is essentially a calculation of capital available for losses. There are additions and deductions. One of those additions is the allowance for credit losses or the allowance for loan lease and losses as today until CECL is effective. But yes, that is an add back from your capital available for losses in the RBC numerator. Back to you, Susan.
All right, thank you. Next up is Catherine. Catherine, does the regular reserve separate designation go away? For example, it's part of undivided earnings.
Thank you. This is Catherine. I'll address that question. Yes, the regular reserves are no longer specifically addressed in Part 702 and can be incorporated into your undivided earnings. However, it's important to note that the PCA regulations have not changed, so the earning retention requirements still remain for adequately, or I should say less than well-capitalized credit unions. I hope that answers your question.
Great, thank you. Next up is Rick. Rick, is there an expiration date where you must opt into RBC, or can you use CULR indefinitely as long as you remain eligible?
Yes, thanks, Susan. This is Rick again. So the last part of that question is the important part. So as long as you remain eligible and you meet the qualifying criteria, you can just stay in CULR indefinitely unless for some reason NCUA changes the rule somewhere down the line. That concludes my answer.
Okay, thank you. The next question we have is, what is the benefit of using CULR or say to opt in? Brian, do you want this one?
Sure, I can take that one. Basically, the benefit to using CULR is that a credit union then does not have to complete Schedule I. So it's primarily eases the burden of reporting. That's the main reason. Back to you.
Great, thank you. Next up is Rob. Rob, are typical credit card undrawn lines considered unconditionally cancelable, thus not included in the denominator?
Hi, Susan, it's Rob. Let me reword that question a little bit. So, first of all, unconditionally cancelable unfunded commitments are not included in the denominator. Now, specifically, a good way to look at the credit card undrawn lines is to think if the credit card agreement or note allows the credit union to terminate or no longer extend credit to that individual without cause, that would meet the standard of being unconditionally cancelable. If it doesn't meet that standard where the credit union can terminate or stop extending credit without cause, then it would be conditionally cancelable, and it would be included as part of the denominator. And that's the end of my response.
Okay, thank you. Catherine, we're going to go back to you. Our understanding is that it is possible to opt in or opt out of CULR any quarter. If we would like to opt out of CULR in a certain quarter, the minimum net worth requirement would change from 9 to 7%. The MBL limit would drop from 15.75% to 12.25% accordingly. What if our MBL assets position happens to be at 14% that quarter? How would a transition look like?
Thank you. Again, an excellent question. Yes, as you've indicated, you may opt into and opt out of the CULR capital framework, but in doing so, it would impact your MBL loan limit. As previously stated, the MBL rule has not changed. Thus, the MBL loan limits should be considered for credit unions opting in or out of CULR. This is also in addition to analyzing the impact of the risk-based capital requirement. Therefore, a change in your capital framework, i.e. opting in or out of CULR, could cause a credit union to be out of compliance with the MBL limit. This is similar to the rule today rule prior to RBC, if you had seen a decline in your net worth, that would have also impacted your MBL limit. So it's very important to look at what the impact could be. There currently is not a grace period, so you would be out of compliance if your MBL to asset position is greater than your MBL limit as a result of you opting out of CULR. I hope that answers your question.
All right, thank you. Next up is Tom. Tom, is secondary capital held by low-income credit unions treated the same as organic capital for RBC CULR purposes?
So I'm going to refer back to the slide where I summarized the usage of subordinated debt / secondary capital for capital purposes. Obviously, if you're like you previously already benefited from using secondary capital as part of your net worth. Of course, it was already approved by NCUA. With the new risk-based capital standards, including RBC and CULR, CULR uses the net worth ratio. So if you're already counting net, subordinated debt or secondary capital toward net worth ratio, yes, you would have the same benefit for CULR because it uses the same rate. Risk-based capital also gives you that ability to add that back in the numerator for risk-based capital. So in both cases, if you're like you and RBC, you'd have the benefit in both places. Thank you, Susan.
Okay. Thank you. All right. Let's see. Next question, let's go to Rick. Rick, will secondary capital and or subordinated debt be counted towards the CULR net worth ratio?
So secondary capital and sub-debt counted toward the CULR net worth ratio. So the answer on that is it depends. If it's a LIQ, yes, and it counts towards regulatory capital. So if it's included in net worth, then it would actually go in there. So, but if it's a non-LIQ and they issued subordinated debt, that would not go into the CULR ratio. It would not be added in, but it would be included in the numerator for the risk-based capital ratio. Hopefully that answered the question. Thanks.
Okay, thank you. I think we maybe have time for one more. So let's go to Catherine. Catherine, if we opt into CULR, does this affect any other reporting or anything other than the call report? Are we opting in to other requirements later if we choose CULR? As I see it, CULR is a great way out of having to report the cumbersome RBC page, but I'm trying to understand what else it will affect or if there's a downside.
Thank you for the question. This is Catherine. Opting into CULR will help you determine your capital classification under PCA. It does help you eliminate the need to complete or to calculate your risk-based capital requirement. It may, however, impact your MBL limit as previously discussed, but the rule does not impact other or create other requirements for you, and the intent was to provide a simplified capital standard for complex credit unions. I hope that answers your question.
All right, thank you. Okay, I think that's all the time we have for questions right now, so I'm going to turn it back over to Tom to close us out.
Thank you, Susan, and thank you everyone who attended today's webinar. Thank you to the presenters and NCUA staff members who participated in the Q&A session. We still have many questions we unfortunately did not get to today. We are going to list an FAQ that will be on NCUA's website in our RBC resources page shortly. So after we get through the questions, we'll summarize them. Hopefully they'll be very substantive and responsive to your questions. Otherwise, you can submit a question, as I indicated on a previous slide or two, to us, to those as well. We realize this is an important project, an important milestone coming up for the agency for 331 call report. So we want to be responsive as possible to make it as smooth as possible for you. So again, thank you all, and have a great day.